Hello and good almost afternoon, Arkansas. How is everyone today? Looks like a couple more people are joining in, so we'll wait another minute or so before we start. And did everyone get to use their Uber Eats today? And I believe if you haven't used the link yet to order food, it should be still good to use the end of Wednesday. And let me know what you ordered for lunch. And we're gonna have Italian food. Right now, we're based in California, so we will not have lunch for another 2.5 hours, but we're gonna have spaghetti, meatballs, some salad. All right, this person has a sandwich, Subway. Someone got a burrito bowl, some pizza, hot dog, hoagies. All right, someone also ordered Italian food. All right. And before we get started, just wanted to go over some housekeeping. At the end of this presentation, I'll be following up with an email to provide the HRCI and Shroom credits. And if you have any questions today, I'll do my best to check the question box and get back to you as soon as possible, as these questions will be saved. And if you want any further information, feel free to respond to that follow-up email. You can also subscribe to our YouTube channel and newsletter, and I'll have those links at the end. We're also going to send a recording of the presentation. You can share with your colleagues. Today, we're going to talk about Arkansas nonprofits and unemployment. And before we get started, just wanted to do a quick intro of myself. My name is Janessa Ponko. I'm the Senior Member Development Representative here at 501. I've been in business development for over 13 years, and I've been with 501 since July 2023. And there's an image of people bowling that includes me and some of our sales and marketing team members. Heidi is my manager in the middle. You may work with her in the future. And then we also have Evan on our right, who does our web development and marketing. I'm really excited to be part of a team that's been helping nonprofits save time and money that can go towards furthering their mission. We're based in San Jose, California, so we're in the heart of the Silicon Valley and dedicated to helping nonprofits reduce unemployment expenses across the nation. Thanks again for joining to learn more about cost-effective strategies in managing unemployment in your state. We're going to provide a broad overview on how unemployment insurance works, alternatives for 501c3 nonprofits when it comes to unemployment, how reimbursing works. We're also going to use some real life examples of nonprofits we've helped with our cost analysis, and then finally provide more information on our company 501c services and how many of our Arkansas nonprofits have benefited from our services. First of all, I wanted to start off with a little history to put unemployment in perspective. Unemployment started in the US in the 1930s following the Great Depression and New Deal, where the federal government wanted to create a safety net for workers who lost their jobs through no fault of their own. Between 1930 to 1972, 501c3 organizations didn't pay into unemployment benefits for separate employees. Although this saved them money from paying such taxes, employees that were laid off couldn't reap the benefits of that safety net that for-profit companies had provided. Now, fast forward to 1972, the federal government changed the law under the Social Security Act where nonprofits were required to pay into unemployment, but they were given different options in how they pay so that tax wouldn't be seen as an unnecessary expense for them. Unemployment is overseen on the federal level. However, each state gets to manage their own programs however you choose. So throughout the US, you'll see different taxable wage bases, tax rates, and benefit amounts. But today we're just going to cover information in the state of Arkansas. When it comes to management, unemployment rates can be adjusted annually and are adjusted by experience. So let's say if you have a year or two of bad claims, your tax rate will increase. And then most states, including Arkansas, run as a task as a or run as a risk pool. So when you're paying state taxes, you're putting money into or your this pool of funds. So you would have access to funds that can pay for your taxes. And we're noticing that a lot of nonprofits are putting more money into that pool than what they're actually getting out. And these total tax liabilities by employers, they're often greater than the claims paid with reserves used in times of recession. And to calculate how much you're paying in taxes, you multiply your taxable wage base by your employer tax rate. So take a guess on what a single claim can cost in the state of Arkansas. So feel free to put some answers in the Q&A box. I have 2,000, 4,200, 10,100, 7,700, 8,400, 92.75. So as a hint, the total cost is looking at the weekly benefit maximum times the maximum number of weeks someone can claim. And in the state of Arkansas, in 2024, the amount of weeks lowered from 16 weeks to 12 weeks, but it may change based on like if in different economic times, but currently we're at 12 weeks. And I see 12,000, 11,300. All right, so the maximum amount of what a single person can claim in unemployment for the state of Arkansas can cost $5,412. And just as a caveat, this is what an employer is charged for employee benefits by the state. So any extended benefits you saw during the recession and extra COVID payments, they were covered by the federal government. And the maximum weekly benefit amount for Arkansas is $451. When we multiply that number by 12 is how we get that $5,412 for the maximum of what a single person can claim on unemployment. The federal government sets the taxable wage base at a minimum of $7,000, and there's no maximum. Currently, Arkansas's taxable wage base is set at that minimum of $7,000 in 2026. So that means for the first $7,000 an employee earns, your organization gets taxed on that. And then the minimum tax rate is at 0.2%. The maximum tax rate is at 10.1%. And those are both set by the state. The last thing I want to note, it's the improper payment rate from the last slide. So it's at 9.93%. And this overpayment equates to over $18 million in overpayments to former employees who are collecting employment from the past 3 years. This is information we get from the Department of Labor. You can see Arkansas is one of the many states that's less than 10%. Although this error rate may seem low, this is money that could have been saved by organizations if they audited more accurately. And it's important to note, as we really encourage you to look over your claims and make sure that you're not overpaying for anybody's claims. Here at 501c Services, we help organizations monitor this. And if you are managing on your own, you want to make sure that you're properly charged for a former employee's weekly benefit amount. And there are three different alternatives for unemployment. One is that you pay the state tax that we mentioned earlier with the tax rate that's set by the state and taxable wages. Another option is that you can self-insure or reimburse for your unemployment, where you just pay dollar per dollar for your unemployment claims. So you're basically only paying for the benefits issued. And then the last option is kind of a hybrid of both, where you buy insurance, it offers a savings of reimbursing while also providing that safety net. Just let you know, reimbursing is not for everyone. The qualifications we look at for considering reimbursing is that an organization must be a 501c3 nonprofit. We recommend a gross annual payroll of $1 million or more, because typically if your payroll is under $1 million, especially significantly less than that amount, what you're paying into the state tax pool is probably pretty minimal. So you might not see much significant savings by opting out. However, there are some cases where you could see potential savings. So we're happy to look at your numbers, even if you're just slightly less than $1 million. We also look at a positive audit of the past 3 years. So that means in order for reimbursing to benefit you, we try to see if what you paid each year in taxes exceeds what you're paying in actual claims. And then we want to make sure that there isn't any major disruption in funding for the next 24 months. So we do recommend to stay with the state tax system if you know if you might have anything from impending layoffs, reduction in workforce, losing funds, or closing programs where your tax rates may go up with experience. And then you'll probably want to wait once those claims decrease. And what it means to reimburse is that your tax rate turns to 0%, and the state will bill you only for unemployment claims you receive over the quarter. It's a great way for nonprofits to save money and be a better steward of donor dollars. The process is seamless for separated employees. No matter how your employees separated, they're still going to go through the same process in your unemployment department, where the state will determine their benefit amount based on their base period pay. The only change is how that quarterly bill is calculated. So instead of paying that state unemployment insurance tax, you're now only responsible for charges your organization incurs. And we work with over 1,500 nonprofits, and several of them are in the state of Arkansas. So you're probably wondering what motivates them to reimburse. In most cases, reimbursing saves money. On average, savings can be anywhere from 20 to 40% compared to paying into the state tax system. And this is really the driver for most organizations to switch. Reimbursing also eliminates any concern of changes in the state tax, such as those tax hikes you can't control, and you become a better steward of donor dollars as you're just paying for the actual cost of claims than into the state pool. Because unemployment is managed by the federal government big picture, reimbursing is allowed in all 50 states, best with employers with over $1 million in gross annual payroll and at least 15 or more full-time employees. If you're on the borderline, we can still talk, as sometimes there are circumstances where we can consider reimbursing for your organization. And if you're smaller and reimbursing already, we can still consider you for our services and how we can help you reduce your risk. And there are a couple different strategies for reimbursing. The first is to manage your own program. This can be risky with the highs and lows of unemployment, and you really need to make sure that you have budget for these claims and that your team is diligent with managing, auditing, protesting, and paying claims to reduce risk and prevent overpaying. Another option is to outsource, like using 501c services to help with the administrative work and managing the challenges that can come with unemployment claims. And then we also have a trust where you can put money aside. The third option is to purchase insurance. Here at 501c Services, we do offer insurance programs. They are a little bit more expensive than our trust and offer different levels of protection. And now we're going to get into some assessments, and I do want to talk about how the state tax is calculated. And so with the taxable wage base, it is customized by each state. And currently, as we mentioned before, Arkansas is at the federal minimum of $7,000. And all employers in the state pay the same taxable wage base. It represents the first $7,000 of an employee's earnings. There's no maximum and can increase or decrease by amount or by any amount each year. And then the tax rate is set annually by the state and is based on experience. So to calculate the contribution amount, you're going to multiply that taxable wage base by the tax rate. So for Arkansas, it's at $7,000 times the tax range of 0.2% to 10.1%. This amount means that if each employee makes over $7,000, a company is paying in between $14 to $707 per employee in unemployment. And what we do to get started on an assessment is that we look at your recent tax rate notice, and in the state of Arkansas, it's called the rate statement. This document includes the contribution rate that is located at the bottom, as well as your last 5 years. So your last 5 years in taxable payroll, and then your recent 2 years of benefit amounts. Typically, we like to look at a 3-year average of claims. So we would recommend to have at least 2 years of rate statements ready so that we can provide further data. We can look at potential savings if it's just one of your rate statements, but if we can get two, we would prefer to have more years in claims history. And just let you know, there's no need to understand everything on this document. Our team will be happy to look over the numbers with you and see what potential savings your organization may have. And coming up is our next two examples. They're going to show nonprofits that we worked with that had large overpayments. They eventually became reimbursing employers and also members of our trust. This is a first example of a human services nonprofit. The taxable payroll is just shy of $1 million, tax rate 4.7%, estimated claims only around $200 per year. And in this case, we look at that three-year average of claims. So they were overpaying $45,000 a year. And think of what you can do with an additional $45,000 for your organization. Here's our next example. The taxable payroll was around $700,000, tax rate 3.38%. Estimated annual claims is $5,900. Estimated unemployment taxes were around $24,000. So they overpaid around $18,000. And a little bit more about 501c services. We were founded in 1982 by a former UCP executive. He was looking at ways to save money for his organization. So he came up with the idea of starting a trust. So he teamed up with 25 nonprofit executives in San Jose, California to create the first kind of grantor trust called the Joint Unemployment Compensation Trust. It eventually became what is now known as 501c services. And then our trust is called 501c3 or 501c agencies trust. And currently we're helping over 3,000 nonprofits in various ways across the nation. In 2016, the founder sold the company back to his employees. So we're now 100% employee owned. From our receptionist to the CEO, every member is committed to our company and serving our members. And then our services are valued tremendously, with our company having over a 98% retention rate. And here are a couple of testimonials our members have shared, and you can go back to these later as I'll send the slides after the presentation. And this is a clip from our 40th anniversary celebration a few years ago. It includes testimonials from Anika Lund and Mike Hoffman from Start Early, Mary Sue and Michael Eady from CISC, Sandy Leota and Chris Marshall of Baltimore Center Stage, and Phyllis Austin and Jason Penniger from Boys and Girls Club of America.
What makes me passionate about working for a non-for-profit organization is because I knew I always wanted to work for a mission-driven organization.
Our mission is to work with immigrant communities so that they can achieve the American dream.
501 helps focus our service to the community by giving us more time.
501 helps us focus on serving our communities by providing services directly to our HR professionals.
The biggest benefit for working with 501 is really the transparency and ability to forecast our costs when it comes to our unemployment benefits.
They also keep our cash flow steady through claims that are sound and take a lot of the admin burden off of us so we can just stay on autopilot.
We're very grateful for all the support you provided over the last 4 decades, and we wish you continued success in the future.
Congratulations, 501, on your 40th anniversary. It's been a pleasure serving with you for the last 24 years.
And like I said earlier, we work with several Arkansas nonprofits, and here's a quick snapshot of these members and also other members across the nation. And as you heard them say in the clip, our members appreciate how we save them time and relieve some administrative burdens that can come with managing unemployment claims. And the first way we help nonprofits is through claims management. Our team will help you manage, audit, and protest claims. So if you ever want to protest a claim, we offer unlimited access to hearing reps. And our team has an 80% average protest win rate. And you'll get a dedicated claims manager once you become a member of our trust. all your claims will go through this online portal where you get notified that a claim has been filed. So you'll go into the portal to respond to these questions. And if you ever go on PTO or forget to delegate these kinds of unemployment tasks, it shouldn't be an issue for when a claim doesn't get responded to in several days, it gets escalated and handled. So a big part of our claims management is that our team doesn't want to see your organization overpay or get hit by those Arkansas error rates. So we can audit those charges for you or prevent you from paying a claim when someone gets terminated. We want to make sure that you're managing these claims and also have enough support to do so. And our HR services includes 3 components. So we offer access to unlimited HR consultations. We have a small, strong, dedicated team that can answer any of your HR related questions. So if you have an ongoing issue, you can develop rapport with a person who will support you, manage any of your HR questions. Our HR services have trainings throughout the year that are HRCI and SHROOM certified. And then we also have an online knowledge library with our HR services. And with the $451 maximum weekly benefits in the state of Arkansas, our goal is to help you keep that cost as low as possible. So if you ever lay someone off, we have our reemployment tool. It offers packages that can range from interview techniques, online coaching, and resume writing. And individuals that have used this tool on average have found a job 4 weeks faster compared to those that didn't use this tool. It's never fun to let someone go, but at least you can give them the safety net and resources to help them secure a new job faster, which in return can help your organization save more money. And then we have the protection. It's the insurance part of our program. Most of our members take our stop loss protection that helps them during catastrophic claims. And then other than the catastrophic claims, for managing the general highs and lows of unemployment, we have the trust account. This is a reserve account owned by your organization where you would save up for those possible unexpected number of claims. And I hope this sparked your interest, and maybe some of you may want to manage your unemployment through us as a reimbursing employer. If you want to look into potential savings, what I would need from you is your recent 4 quarters of 941s or your estimated payroll from 2024 to 2025 as a reimburser. If you're currently paying into the state tax system, I would need a copy of your 2026 rate statement. It would also be helpful if you have your 2025 version so that we can also look at additional data for you. And there were a few questions that had popped up, so I can go over them. Let's see. So the first one is, does it cost anything for these services? Yes, we do have our trust administrative fees. The pricing is based on the size of your gross annual payroll, and our service fees will also be included in a cost analysis that you can do with us. And this person asked, we're already reimbursing, but how can we calculate what is our possible state unemployment tax rate when we try to present this state tax as part of our employee benefits? So as a reimburser, you're not paying into state taxes, but what we can do is provide a proposal. It can show what you're currently paying for actual claims and the fees of our services. And we can also do like another analysis to see like what your expenses would be if you went back into the state tax system compared to what you're paying as a reimbursing employer. And this company is a small nonprofit. It's a little bit under 16 employees. Is being a reimburser truly benefiting us? And then if we decided to make a switch also back into the state tax system or just pay state taxes again, is that difficult? So this person is wondering if it's hard to switch back to the state tax after reimbursing. And we're more than happy to do an analysis to help you review like what would be the most cost-effective way to manage your unemployment, and switching back to the state tax system isn't too difficult. And we can make a recommendation of the most cost-effective option. So what we'll do is like check out the cost analysis first, and then also give you more information for your organization for whether you're reimbursing now or if you're paying into the state tax system. And we have one more question here. As a nonprofit, if we're exempt from income taxes, why are we required to pay for unemployment? So nonprofits need to pay their former employees unemployment, and they can do that by funding it through paying the state tax, so SUI, or paying for it dollar per dollar, which is reimbursing, like the few scenarios that we went over. And what I said before in the beginning, this was determined by the Social Security Act in 1972. So all nonprofits are required to pay into unemployment, but they're given different options in how they pay. And so it's leaving only religious institutions exempt from unemployment. And so currently I don't see any other questions. Just let me know if you have any more questions coming up. If you are still typing, I'll stay on for another minute or so, or you can save that question for the follow-up email I'll be sending in a few hours. So the follow-up email will include the HRCI credits and attachment of the slides. And then we're also going to send a recording of through Zoom in the next few hours. And here's my contact information. And if you want to look at more information, we have our YouTube channel and you can sign up for our newsletter for any upcoming events and more information. Thank you so much again. And hopefully everyone has a great rest of their week and have a great day, everyone.